Blackstone, as you know, but others may not, held its first investor day in 4 years on Friday and revealed a lot about its future. A new initiative in life sciences that you're talking about, an expansion into Asia, a tilt toward growth and technology, an emphasis on permanent capital, and a bunch of specific funds you plan to raise. Why reveal so much about your strategy?
Well, it had been a while since we sat down with investors, and we wanted to give them a comprehensive update. And a lot has changed at Blackstone since 4+ years ago. I think the biggest thing that's changed is just the way the firm has expanded. If you went back really even further, the firm was more focused, let's say, in private equity and real estate private equity. And we've seen this proliferation of things we do, all built on the back of delivering great performance for our investors. We've delivered great returns. That's given us the confidence of investors, and they've allowed us to expand our platform. So as you said, we've got a bunch of different initiatives. We can talk about some of those, but we're excited about those. And we also wanted investors to understand that the nature of our company is changing. We're moving, as you mentioned, to perpetual capital, long-term vehicles, and that's leading to not only accelerated earnings, but an improvement in the quality of our earnings.
Quality because more of it is fee-related as opposed to carry?
Yes. If you look at our business, we get paid in two ways. We get base management fees. We also get performance fees. The market puts a bigger discount on performance fees, even though we've shown over time we've been able to generate them over good times.
It's a sore spot.
It's a bit of a sore spot for us, but we understand the market likes more recurring earnings that are more predictable. And so we've said, look, if you look at the mix shift that's happening, if you went back to 2017, about a third of our earnings were fee-related. We said over time that could grow to as much as 2/3.
John, scale is a word used in conjunction with Blackstone frequently. You pointed out on Friday that Blackstone has attracted almost as much capital in the past 5 years as your three largest competitors combined. Why is it important to be the biggest? Why is it important to grow by the most?
Yeah. For us, scale has proven to be over and over again a real competitive advantage. So what do I mean by that? One is in buying assets. You know, if you think about it in public markets, if you want to buy $1 million of stock and I want to buy $1 billion of stock, you have a competitive advantage because I'll move the market. If you go to private markets, when Thomson Reuters wants to do a $20 billion deal, we end up in a bilateral discussion. The same thing when GE wants to sell 20+ billion of real estate. So scale for us across our platform really matters. It also gives us all sorts of information. So if you think about our portfolio companies, what we're seeing on the ground around the world, again, that allows us to do more. And there are all sorts of adjacencies against our scale. So the reason we've been able to move into Europe and Asia, the reason we've been able to expand private equity into energy, into core private equity, all these activities is because we have this large base and we can grow off that. So for us, scale is really important. We'll continue to emphasize that in our investing. And again, it helps us drive higher returns, which is really the essence of our business.
It is as simple as bigger is better.
Bigger is better in the private markets over and over again. If somebody needs a solution in a hurry, if you need to borrow a bunch of money and you need $1 billion or $2 billion, you can call us and our GSO folks can show up and give you a solution.
What about the risks of being so large?
Well, the classic risks are you have a lot of money, there's not a big opportunity set, and you're worried that returns go down. But if you look at our history over time, it's been the opposite. You know, we report all our returns, and even though our scale has grown, our returns have continued to be very strong. And if you look at things like the private equity industry, and you went back to 2007, you'd say the private equity industry is up 50-60% in dry powder, yet the number of large-scale funds, over $15 billion, is basically the same. So we continue to find the air being thinner for larger scale opportunities, and so we like operating in size.
So all of this dry powder that we hear about, and of which Blackstone has how much?
$88 billion today.
Unlevered.
Unlevered.
So you could put $88 billion to work, put 5 times leverage on that, and all of a sudden we're talking about an enormous amount of money.
Maybe not 5 times, but yes, a fair amount of buying power.
So you're not afraid, you don't feel that having that much to commit, if you will, to put to work, is problematic?
No.
No.
No, because again, the markets are enormous. That 88 is across all sorts of industries. It's in infrastructure, it's in credit, it's in real estate, it's in private equity, it's in the US, it's in Europe, it's in Asia. And we've got time. Almost all these funds have 5+ year durations. We're not forced to put the capital out. We're being very patient. We're looking for good opportunities. We're waiting for, when you're looking at balls and strikes, you swing when you see a good pitch. And so I feel really good about the process. I feel good about our prospects to deploy capital. And if the markets turn sideways, we'll be patient.
Some years ago, Eric Schmidt used the term four horsemen to describe the unrivaled power, capabilities, and influence of Google, Facebook, Apple, and Amazon. Should we think about alternatives the same way?
Meaning a small number of firms?
Small cohort of firms with enough scale, to use that word again, to put distance between themselves and the rest of the industry.
Well, there is clearly a group of us who are growing more quickly, who are larger. But there are also a lot of small and medium-sized players. It's not necessarily a winner-takes-all business, but I do think
winner takes most, maybe.
Maybe we're getting greater share, but again, it's based on performance. So if we deliver really great returns, capital flows our way. That has been the virtuous cycle of our business. Deliver great returns, investors have confidence in us, and you mentioned earlier about us emphasizing growth. Right? So that's an area we haven't done as much historically. We have the ability to move in that area, be it life sciences or technology or Asia. But I don't think that pointing to a firm or a group of firms that's somehow locking out or limiting competition in any way, shape, or form. We just see that as we do better, our firm has the opportunity to grow.
But it has to be hard. If you're not Carlyle, right? If you're not KKR, if you're not Apollo, Oaktree, Ares, Brookfield, I guess, TPG for sure, and Bain, they're all either at or in excess of $100 billion in AUM. If you're not one of those firms, pretty hard to get there, isn't it? And of course, there's Blackstone at the top of them all.
Yeah, it's harder to get there, but there are some great firms that are out there that are aspiring to size. But as we talked about earlier, there are real advantages to size. There is an ability to attract people. I would mention my favorite stat from our Investor Day on Friday is that for our 2018 incoming analyst class, we had 15,000 applications for 86 spots. So the power of the brand, and that's something that's also very special about the firm, is really valuable to us. And so, yes, as we move into some of these other areas, be it retail or insurance, being large, being able to offer a range of products, a range of geographies, is a competitive advantage.
Do you see yourself on a collision course with BlackRock?
Not really. I mean, their business, they may and have moved into the private space, a bit into the alternative space, but their business, I think, is primarily about liquid markets.
Sure, but they grow on an annual basis by more assets than Blackstone has.
Yes, but obviously more liquid in nature. I think what's interesting, what's happening, both BlackRock and Blackstone, which started in the same building on the same floor not that long ago, are benefiting from the powerful trends in the asset management area, which is low-cost ETFs and index funds are seeing huge flows. And alternative managers, Blackstone, are seeing big inflows as well. And that's because in both areas we've seen stronger performance. So I see both of these firms succeeding going forward.
One of the things that didn't quite add up for me on Friday, John, is this. You've got $439 billion in AUM now. You laid out a trajectory to get to $1 trillion in 8 years or so. At the same time, you said you expect an additional $200 billion or so to come from the retail channel, private wealth. And Tony James, your predecessor as president, said that insurance could be the biggest business in terms of AUM. So that's $400 billion or more over where you are now, which suggests to me that you're doing one of two things. Either your traditional investors, right, pension plans, endowments, and sovereign wealth funds, are going to, on a relative basis, invest less than they have been with Blackstone, or you're lowballing that $1 trillion number. Which one is it?
I don't think we're lowballing this, and I don't think we're definitely not moving away from our traditional investors. But I think we're giving a sense for people that there's big opportunity here, that there's big opportunity with our large established businesses, private equity, real estate opportunistic, our secondaries business. There's big opportunity in this perpetual capital, these long duration open-ended vehicles. And yes, there's big opportunity in retail and insurance because unlike the institutional market, which is a quarter allocated to alternatives, in those areas they're about 5% allocated. And we think they face the same challenges in terms of return, and they've got the ability to invest for the long term. So we look at this and say, there's a lot of white space. We've got a terrific firm, great capabilities to deploy capital. We can do this. It will take time. And again, returns are the essence of this. We don't want to just raise capital and not be able to do a great job. So I don't think it's lowballing. I think we're taking a long-term approach to building this business.
Permanent capital, non-redeemable capital, if you will. Why is it so important?
It's important because it compounds and grows. It allows us to serve our customers in a different way. In fact, if you look at real estate, we were in the opportunistic space. Buy it, fix it, sell it, send the money back. Some of our big investors said to us, hey, that's great, but that's a small portion of what we do in real estate. Can you give us long duration capital that's in the ground the whole time? We'll take lower returns, operate with lower leverage, and we get the benefit of decades of compounding. And so we moved into that space. We've managed to do a great job delivering for our investors, and we're growing rapidly. It's grown from 0 5 years ago to $30+ billion today.
Of permanent capital.
Permanent
so that's
capital.
still less than 10% of your total.
Correct.
Where do you think it'll be 5 years from now?
Well, I think Ken Kaplan, who co-runs our real estate business today, said over the next several years it could grow to 60 billion plus, which is a doubling from where it is today. And we also talked about, from a revenue standpoint, going from $250 million today to more than $1 billion in the next few years. So the potential on this, on infrastructure, our credit BDC, a whole range of these perpetual capital activities, the potential is quite big.
Life sciences is an example of this tilt, as I'm using your words here, toward growth and tech. What else belongs in that camp?
Well, I think backing up, the reason why you want more exposure to growth is we're moving out of this environment of rates coming down, which we've been in for 30 years. And in an environment of rates going up, you're less likely to see multiple expansion. And so to drive earnings value or drive value growth, you need an increase in earnings. So where does the growth come from? Life sciences, tech, and growth equity, which is an area we've invested in private equity and tactical opportunities, but we could do more there. Asia, which you mentioned, which is growing 2.5 times as fast as the rest of the world. So I think as a firm, we'll be moving even more in that direction. We just raised 2 large funds in Asia in that regard.
Tony James put up a slide on Friday listing a number of other initiatives that he said are already underway. So let's go through them, and you can tell me a bit more about what Blackstone's doing. Capital markets.
Capital markets, today we touch a ton of transactions. I don't add it up, but it's in the several $100 billion a year. Through that, we get a lot of market insights. I think we could create some value doing that. We have a capital markets activity which helps our customers today. I think we could do more, but we want to be sensitive to not being an asset-heavy company. We've run our business balance sheet light. That's going to continue.
You talked about the possibility of placing the debt that your deals, in private equity deals, for example, incur, debt that you previously gave to the street. What do you mean by that?
Well, today when we go buy a business and we borrow money, we finance it with third parties, and that's pretty much what we do. But we actually have investors who've come to us and say, hey, we'd love to get some of that on a more direct basis. So if we could help place a portion of the debt, the banks are still going to do the lion's share of this, but we might be able to do a small piece of that activity.
A tranche.
A tranche of that.
How would you price it without running into the principal agent problem?
Well, you would only be able to do that if you took a minority stake and if the pricing was done by a third party. So you have to be very thoughtful on conflicts whenever you're engaged in these activities.
Growth equity is a component of the growth tilt that you described. Does that mean you're going to do what, say, TPG does now or General Atlantic does now?
I think over time we'd like to have more of those capabilities. I think we need the right people. We're building some of that capability. I think that is a real opportunity given the way the economy is changing so rapidly.
How do you define scale in that business? What's the AUM to matter?
I don't really want to get into this. Again, we've got to have enough scale so that we can do a good job. I think in that area, like others, having scale matters. But oftentimes we start these businesses smaller. I mean, not every business starts at a huge number. It starts, and then we build up a track record and grow it.
There are a bunch of others: primary, private equity fund of funds, residential mortgages, structured debt, an ESG fund. What's going on with those?
Those are all just different areas we can look at. We're not going to get into all of them tomorrow, but it's just a sense that the alternative space is a very big market. I think there was a sense early on that you could only get so big, and when we went public, there was a lot of questions around white space, both into how many activities could you engage in, was there enough capital out there? The reality is investors are interested in alternatives. They want to take a long-term view. I think not everybody needs money just for a daily basis. It's true in the individual investment side as well. And there's a whole range of activities, and we're sort of filling in that board.
John, I know Blackstone has looked at leasing. Where did that go?
Leasing? You mean like the ABS market? I mean, I think as part of lower return fixed income things like we do in insurance, that could be an area. There's always things we're looking at. I would say, though, what matters so much, Steve touched on this at our meeting, which is we need the right leadership. So to do these things, either we bring in people internally, and often we bring in people externally. We don't want to go into a business if we can't be great at it, if there's not a market opportunity. That's critically important, and we need a great investment process, too.
I know there's also been some discussion about taking the quant team inside your hedge fund solutions business and creating something that would, say, compete with an AQR or a Dimensional. Where's that going?
Well, I would say right now what we're most focused on our data team is harvesting all the information we get from our portfolio. So if you look across Blackstone and you think about the scale, the multi-$100 billion of assets we control, we get lots of data. So our data team today is really focused on...
You get it from portfolio companies, you get it from the other private equity firms in which you have stakes or hedge funds in which you have stakes.
Real estate we own, all sorts of things. And if we want to be better investors going forward, maintain our edge, I think there's more we can do there. Could we manufacture things in the hedge fund solutions area? Yes, that's an opportunity, but we're not there today.
What kinds of economic signals are you getting right now from this portfolio of 180 companies, not to mention all the real estate assets that you've got?
I would say on the ground in the U.S., very positive. So if you look at revenue growth or our CEO sentiment surveys, they all look quite green. Very positive, which is consistent with the data we're seeing in the U.S., unemployment claims down, consumer confidence. I'd say the one cautionary sign is the difficulty of attracting labor here in the U.S. and wage rates. So
how difficult is it?
It's getting harder, certainly skilled labor, but just labor generally. The headline number was 2.9%. Our data would indicate that it's maybe even higher, 3.5%, some industries 4%. So that's a positive for U.S. workers, but for companies' bottom lines, there will be some impact, and that's something we're watching.
And how about Europe?
Europe. So I would say in Europe, what we're seeing on the ground is actually decent. The headlines, of course, in Italy are tougher. The headlines in Brexit are tougher. But our businesses are generally doing pretty well. And I'd say in places like Spain, where we've made a large call on hotels and residential, the signs are pretty good. So I'd say Europe, things are okay. And from an investment perspective, Europe, although it will grow certainly more slowly than the U.S., global enthusiasm for Europe's lower, so it's made it an interesting place.
Let me take you back to your old business, real estate, for a moment, John. Blackstone owns an awful lot of office space. Why don't you do with that space that you already own on behalf of your investors what WeWork is doing?
So we've got a little bit of that. We have a company in London called the Office Group that does this in a small scale. Small scale. I would say for us, it's not the business we're in. It doesn't mean we couldn't expand into it. I think WeWork's done a tremendous job building a great business. There is an opportunity, long-term and flexible workspace. I don't want to count anything out. I don't expect we'll be a major competitor.
And the last question for you on real estate. Are you raising funds to take advantage of President Trump's Tax Cuts and Jobs Act, specifically associated with the benefits in those qualified opportunity zones?
We haven't. I think it's an interesting area for individual investors that hasn't been a focus for us at this point.
Why not?
You know, it's probably more development oriented than what we do. We typically buy existing assets, hopefully at a discount to replacement cost. So it's not really what we do. And then there's, I think, a scale question for us. But I do think for some people it'll make a lot of sense.